Good morning, everybody. It's John Thompson here with the TG Loans Mortgage team at C2 Financial, and it's time for today's Borrow Smart, Repay Smart video lesson. Today, we're going to be talking about essentially, should I buy now or should I wait? And the idea being that, what people are always trying to figure out is, does it make more sense to buy in the current market, or do we wait if the market's going to drop a little bit? We know where rates are at today. We don't know really where rates are going to be tomorrow, but maybe we have an inclination that prices are going to drop on homes. So we're going to explore the idea of, okay, so we buy now at low rates, or we wait a couple of years and we see what the market's doing then, and then maybe there's a price drop, and we see at the end of the day what how it all comes out. And if rates are a little bit higher, then what's that impact? All right. So cost of waiting. So a common question is, we buy now with rates lower, wait till prices drop when rates may be higher. We're talking about initial investment, down payment, cash flow, increased net worth is sort of the objectives of those different lessons. All right, so in this example, and follow along with me here, we're talking about a $600,000 purchase price. We're talking about getting a normal 30-year fixed. Rates are lower in this now, but this is still a valid example. We're really talking about a 0.5% rate increase. So you'll see here the payment on $600,000 buying today with 5% down is $39.32. As you flow down through this is over a 30-year period. Here's your total payments. You pay back the money you borrowed initially at $570. You've made total payments of about $1.3 billion, which is a shocking number in and of itself. But putting that aside, your home value, assuming a 2%, and again, I'm using a 2% appreciation rate, which is very conservative, is a $1.474 million on the property. Okay. On this side, we're going to say we wait 2 years. Again, we're waiting 2 years. Rates go up 0.5% to 5.25 from this hypothetical 4.75. The payment now is $36.96. We saved about, I think, $225 a month is what it is. You'll see total payments. You paid back $448,000. And theoretically, if you had saved your cash, the difference in payments, which I'm going to show you here in a moment, you'd have that cash in the side. So at the end of the day, what this really means, you've saved $236 in payments, but you lost $225,000 in wealth. Let me go back real quick. That's because the home is now worth $1.249. Okay, so at the end of the day, you wait 2 years, rates are lower, you got a lower payment, you saved $236 in payments, but you lost $225,000 in wealth. And you said, well, what if I just save that $236 a month and I just put it in the bank and I invest that money over time? That would offset it. Well, the reality is, it does offset a little bit. It's now worth $129,000, which you can see kind of down here, $129,000, but you're still ahead by $159,000 over here. All right, so let's look at a different example here. $600,000 down, and we've got, again, the same interest rate over here, payments 5% down. Now we're going to look at a 1% rate increase, 4.75 to 5.75. Same example over here, the home is now worth 1.474, but in this example, you only saved about $75 a month, but you lost $251,000 in wealth over that same time period. All right, so interesting story. That doesn't mean you should wait or not wait, but the bottom line is, don't make the assumption that you're going to save a lot of money by waiting to see if prices drop. The reality is that interest rates have a lot more to do with your long-term wealth accumulation than your starting price on the home. All right, so thanks very much. Hope you enjoyed this lesson, and we'll talk to you soon. Thanks. Take care.